There is a building in Switzerland that most people will never enter, never vote for, and never even hear about. Yet the decisions made inside it quietly determine whether you get a loan, whether your business survives, and whether the global economy collapses or holds together. This is not Wall Street. This is not Washington. This is the most powerful financial tower on Earth, and almost no one is allowed to look inside. If you take a train into the quiet industrial city of Basel, Switzerland, and walk toward the central station, you'll notice something unsettling. Rising above the surrounding buildings is a massive concrete cylinder, cold, brutal, and completely out of place. It doesn't look like an office building. It looks like a nuclear cooling tower. This structure is the headquarters of the Bank for International Settlements, known simply as the BIS. It is not a normal bank. It doesn't serve customers. Its members aren't people. They are central banks, the Federal Reserve, the European Central Bank, the Bank of Japan, and even the People's Bank of China. Every 2 months, the most powerful monetary officials on the planet gather inside this tower for closed-door meetings. The land beneath the building is legally not Switzerland. It has diplomatic immunity, like an embassy. It has its own police force. Its documents are untouchable. No judge anywhere in the world can demand to see them. Its officials are immune from prosecution. For all practical purposes, this is a sovereign state devoted entirely to money. And inside this tower, in quiet wood-paneled rooms, a small group of unelected technocrats writes the invisible code that governs the global banking system. These rules are called the Basel Accords. They determine how much money banks can lend, how much risk they're allowed to take, and ultimately whether the global economy booms or collapses. If you've ever wondered why your mortgage was rejected, why credit is tight, or why the 2008 financial crisis happened, you don't need to look at Wall Street. You need to look at the Tower of Basel. This story begins with a failure. In 1974, a German bank called Bankhaus Herstatt collapsed in the middle of the trading day. Because of time zone differences, American banks had already sent money to Herstatt in the morning. But before the bank could send payments back, German regulators shut it down. The money vanished. Banks panicked. Transactions froze. The global financial system nearly seized up. For the first time, central bankers realized something deeply dangerous. Banking had gone global, but regulation was still local. A failure in Germany could cripple banks in the United States. There were no global standards, no emergency procedures, no shared rules. So the world's major economies formed a committee. It was called the Basel Committee on Banking Supervision. Its mission was simple: make sure banks everywhere held enough protection to survive a crash. After years of debate, they released their first agreement in 1988, Basel I. It was just 30 pages long, but it changed global finance forever. The core idea was capital adequacy. Every bank had to hold capital equal to at least 8% of its assets. If a bank lent out $100, it needed $8 of its own money to absorb losses. Simple, sensible, responsible. But then came the detail that changed everything. The committee introduced risk-weighted assets. Not all loans were treated the same. Government debt was considered perfectly safe. Corporate loans were risky. Mortgages were somewhere in between. So they assigned numbers. Government bonds got a 0% risk weight. Mortgages got 50%. Business loans got 100%. With one equation, the global economy was quietly rewired. By declaring government debt risk-free, the Basel rules told every bank on Earth the same thing. Lending to governments is cheap. Lending to businesses is expensive. Banks followed the incentives. They flooded into sovereign debt. Governments discovered they could run massive deficits without resistance. Housing exploded because mortgages required far less capital than business loans. Banks stopped funding productive industry and started funding government spending and real estate. The rules didn't just regulate the market, they distorted it. But banks are not stupid. They found a loophole. If a bank held a corporate loan, it needed capital. But if it sold that loan to someone else, suddenly it didn't. This gave birth to modern securitization. Banks began originating loans, packaging them into bonds, and selling them off their balance sheets. Risk disappeared on paper. The quality of the loan stopped mattering. This was the seed of the 2008 financial crisis. Banks weren't acting recklessly for fun. They were optimizing regulatory math. By the late 1990s, everyone admitted Basel I was too crude. So the committee went back to the tower. In 2004, they released Basel II. It was no longer a pamphlet. It was hundreds of pages of formulas. Risk was now scientific. Instead of simple categories, banks relied on credit ratings. A meant low capital requirements. Junk meant higher ones. The safety of the global banking system was quietly outsourced to 3 private rating agencies. Then came the fatal mistake. Large banks were allowed to use their own internal risk models. They argued their math was more sophisticated than the regulators. The committee agreed. Banks were allowed to decide for themselves how much capital they needed. In hindsight, this was madness. It was letting students grade their own exams. Unsurprisingly, every model reached the same conclusion. We are safe. We need less capital. By 2008, European banks, fully compliant with Basel II, were loaded with AIA-rated subprime mortgage bonds. The rules didn't prevent risk. They hid it. When housing collapsed, the models failed, the ratings evaporated, and banks discovered they had almost no real equity. The system designed to prevent a crash had camouflaged the bomb. After the crisis, regulators didn't abandon the system. They doubled down. In 2010, they unveiled Basel III. Capital requirements rose. Leverage was capped. But the biggest change was liquidity. Banks were forced to hold massive reserves of high-quality liquid assets, mostly government bonds, to survive a 30-day crisis. On the surface, it sounded sensible. In reality, it transformed banking. Lending to businesses became unattractive. Holding government debt became mandatory. Banks turned from engines of growth into storage lockers for sovereign bonds. The system became safer and more fragile at the same time. This paradox was exposed in September 2019, when the repo market froze. Banks had cash, but regulations prevented them from using it. J.P. Morgan sat on the hundreds of billions and did nothing, because lending would violate Basel liquidity rules. The Federal Reserve had to step in. By making individual banks safer, Basel III made the system weaker. Credit demand didn't disappear. It moved into the shadows, into private credit funds, into institutions not bound by Basel rules. Blackstone, Apollo, KKR. A 2-tier financial system emerged. Regulated banks that hold government debt, and unregulated giants that take the real risks. And now comes the uncomfortable question. If one of these shadow institutions collapses, will governments really let it fail? The entire Basel system rests on a single assumption. That government debt is risk-free. But rising interest rates in 2022 and 2023 proved otherwise. Bond prices collapsed. Losses were hidden through accounting rules. Capital ratios became illusions. The system designed to ensure transparency institutionalized denial. The Basel Accords were meant to make the system safe. Instead, they crushed lending, entrenched monopolies, and pushed risk into places regulators can't see. And now, above it all, stands a new power, a firm larger than most countries, more influential than central banks, running global finance through an AI system few understand. In the next video, we're going inside BlackRock. Inside Aladdin, the machine managing over $20 trillion of the world's money. Is it the ultimate risk manager or the most dangerous financial weapon ever created? Subscribe, because what comes next is bigger than the banks.